from broker supervision to final financial control. As we move forward from Section 33, where we focused on disclosure requirements and the importance of clearly communicating material information to prospective tenants, we now arrive at the final section of this course, Arizona Real Estate Trust Accounts. This is a fitting place to end because trust account management brings together nearly everything we have covered throughout the class: broker supervision, record-keeping, disclosures, agreements, liability, communication, and compliance. If earlier sections explained how to build a compliant property management operation, this final section focuses on the financial system that must support and document that entire operation. The Arizona Real Estate Trust Account Reconciliation Process is one of the most important compliance requirements for brokers and property managers. Under ARS, paragraph 32-2151B, the broker must complete a monthly three-way reconciliation between the trust fund account bank statement, the client ledgers, and the trust fund account ledger, and must provide an explanation for any variation. This is not simply an accounting task, it is a legal requirement. It is the monthly proof that the money held in trust is being tracked correctly, and that the broker is honoring fiduciary duties to clients and tenants. A three-way reconciliation matters because trust accounts often contain funds belonging to multiple owners and tenants at the same time. Without accurate reconciliation, a broker cannot know with confidence whether all funds are properly accounted for. If the bank statement balance, the overall trust account ledger, and the total of all client ledgers do not match, then something is wrong and it must be explained immediately. This ties directly back to our earlier sections on trust account liability, broker supervision, and documentation. A broker who does not reconcile monthly is not just disorganized, they are out of compliance. Arizona law goes even further by identifying specific variations and mistakes that are considered violations. Under ARS, paragraph 32-2151C, it is a violation to fail to remove interest earned on a trust fund account at least once every 12 months. To commingle client funds with personal or business funds, to fail to identify non-owner tenant monies in descriptive receipts, to fail to maintain separate ledgers for each property, to fail to complete regular three-way reconciliations, to transfer monies between accounts owned by different persons without written consent, to fail to create checks and balances, or to fail to follow state or federal requirements. These are not small technical problems. They are exactly the kinds of issues that can lead to audits, sanctions, fines, and license discipline. The Trust Account Receipts and Disbursements Journal, sometimes called the checkbook register, is another critical part of the trust account system. This journal records the flow of money into and out of the trust account. Each entry should include the date of the transaction, whether it is a receipt or disbursement, a description of the transaction, the amount, the source or payee, the check or reference number, the running account balance, the property or client identifier, and references to supporting documents such as invoices or receipts. This journal creates the day-to-day audit trail that supports the monthly reconciliation. Without it, even a broker who wants to be compliant will struggle to reconstruct what happened in the account. Client ledgers are equally important. Arizona requires separate ledgers for each property, which means a broker cannot simply track everything in one pooled account without property-level detail. Separate ledgers show exactly how much money belongs to each owner or property, and allow the broker to prove that client funds are being handled separately and correctly. This ties directly back to the broader theme of this course. The broker's responsibility is not only to protect money, but to be able to explain and document where every dollar belongs. Record-keeping requirements are also central to trust account compliance. Property managers must keep bank statements, canceled checks, deposit slips, receipts and disbursement journals, owner statements, client ledgers, and bills or invoices. Monthly trust account reconciliations and supporting ledger balances must also be kept. Property management agreements generally must be maintained for at least 5 years from termination, while residential rental agreements and related documents are generally kept for 1 year after expiration, unless they are provided to the owner upon termination of management. These record-keeping rules reinforce the idea that property management is a documentation business as much as it is a people business. Another important concept is that the security deposit belongs to the tenant. The landlord or the landlord's agent, often the real estate broker, holds the deposit for the tenant pending full performance of the lease obligations. That means the deposit is not brokerage money, and it is not owner money until lawful deductions are justified. This ties directly back to earlier sections on security deposit handling, tenant complaints, and disclosure obligations. A broker who misunderstands the ownership of security, deposit funds creates unnecessary risk from the very beginning. Commingling is one of the most serious trust account violations. If a property management company deposits rents or deposits into its operating account and then uses that money to pay its own business expenses, it is improperly mixing client funds with brokerage funds. Arizona law strictly prohibits this. When ADRI discovers commingling, the department may investigate, audit records, issue a notice of violation, and impose sanctions ranging from fines to license suspension or revocation. In severe cases involving fraud or intentional misuse, the matter may even be referred for criminal prosecution. This is why trust account rules are treated so seriously. Commingling is not merely sloppy bookkeeping, it is a breach of fiduciary duty. Arizona also places clear limitations on who may act as a signer on a property management trust account. Under ARS, paragraph 32-2174(c), the broker may allow either a licensed agent or an unlicensed individual directly employed by the broker to transfer funds or act as a signer. However, neither the broker nor the authorized signer may be a signer on the owner's separate account, and property owners themselves are not signers on the broker's trust account. This ties directly back to our earlier sections on signature cards, delegated authority, and broker liability. Access may be delegated, but the broker remains responsible. Property management compensation must also be handled correctly. Compensation to licensees may not be paid directly out of the property management trust account. Those funds must first be transferred to the broker's operating or commission account before compensation is paid. The trust account may contain only limited broker funds, generally up to the statutory threshold allowed to keep the account open or avoid minimum balance penalties, and the broker must monitor this closely. This reinforces the distinction between trust funds and brokerage funds, which has been a recurring theme throughout the class. Contract law also plays a major role in the trust account process, because the broker's handling of money is shaped by agreements with owners and tenants. Management agreements and lease agreements define expectations for rent collection, deposit handling, reporting, and dispute resolution. When contracts are clear and systems are strong, trust account operations become much easier to manage. When agreements are vague, trust account issues often become more difficult to resolve. Having legal counsel available is one of the smartest risk management steps a brokerage can take. Property management involves constant interaction with contracts, statutes, trust account requirements, tenant disputes, and compliance rules. An attorney familiar with property management can help review agreements, advise on difficult situations, and reduce the chance of expensive mistakes. In the same way, using an experienced third-party company to help set up and train staff on trust account systems can provide a strong foundation for a new property management business. Good systems at the start often prevent major problems later. As we close this course, one theme stands above all the others. Property management is a system of accountability. It is not enough to mean well, work hard, or respond when problems appear. Brokers must build policies, supervise people, protect funds, document activity, communicate clearly, and follow the law consistently. Every section of this course has pointed back to that same idea in a different way. Trust account management is where all of those lessons come together. If the agreements are clear, the disclosures are proper, the records are strong, the communication is consistent, and the supervision is active, the trust account system becomes a reflection of a healthy brokerage. If those pieces are missing, the trust account is often where the first serious warning signs appear. This course has shown that property management in Arizona is much more than collecting rent and calling vendors. It is a profession built on legal duties, financial integrity, operational discipline, and ethical responsibility. The brokers and managers who succeed are the ones who do the little things right, month after month, long before an audit or complaint ever appears. Closing remarks. As we wrap up BMC 3B, remember that the strongest property management companies are not built by luck. They are built by brokers who understand that compliance is not a one-time task, it is a daily habit. Strong agreements, strong supervision, strong accounting, and strong communication create stability for owners, tenants, and the brokerage itself. The goal is not just to avoid discipline. The goal is to build a business that is professional, transparent, profitable, and trusted. If you take the lessons from this course and apply them consistently, you will be in a much stronger position to protect your clients, protect your license, and build a property management operation that lasts. Online discussion. Why is the three-way reconciliation such an important part of trust account compliance in Arizona? Answer: because it verifies that the bank statement, trust account ledger, and client ledgers all match, helping ensure that client funds are properly accounted for and protected. Why is commingling considered one of the most serious trust account violations? Answer: because it mixes client funds with brokerage or personal funds, breaches fiduciary duties, and creates a significant risk of misuse or loss of client money. How does strong trust account management reflect the overall health of a property management business? Answer: because accurate reconciliation, record keeping, and controls show that the brokerage has strong systems, good supervision, and consistent compliance practices. Multiple choice questions. What must a broker complete monthly under ARS, paragraph 32-2151B? A three-way reconciliation between the bank statement, client ledgers, and trust account ledger. Answer: a three-way reconciliation between the bank statement, client ledgers, and trust account ledger. Which of the following is a violation under ARS, paragraph 32-2151C? Failing to maintain separate ledgers for each property. Answer: failing to maintain separate ledgers for each property. Who does the security deposit belong to during the lease term? The tenant. Answer: the tenant.